Okay. Hello, everyone. Good morning. I hope everybody has joined in and I can wait for a minute. We can start in a minute so that whoever is still in the process of joining can join so that we can start. I can see in the chat box, Shailesh has joined in. Good morning, Shailesh. Shruti, good morning. Good morning, Kushma. So I get to know, participants have joined in if they can just use the chat box quickly. Okay. I think it's time now. So we should start. So again, good morning, everyone. I hope everybody had a good sleep. And today is a festival day as well. So happy Diwali to all of you in advance. So we'll start with India's 37 for today. The name of the standard is Provisions, Contingent Liabilities, and Contingent Assets. So the standard revolves around three items. Number one is provisions. Number two is contingent liabilities. And number three is contingent assets, right? So the earlier two terms we have heard before as well in IGAP, but the contingent asset is the new, term which we will be discussing under this Ind AS. So what all accounting and what all disclosures are required for the provisions, contingent liabilities, we will see, and what is their standard is talking about around contingent assets, we will also see. So just to quickly, just a minute, let me adjust the bar. Okay. So the objective of the standard is to ensure that appropriate recognition criteria, okay, and the measurement basis are applied to provisions, contingent assets, and contingent liabilities, right? So all we are going to talk about is about these three items: provisions, contingent assets, and contingent liabilities, right? So what we need to, disclose sufficient information is disclosed in the notes to enable users of the financial statements to understand their nature, timing, and amount. So what does this mean? So what is the nature of the provisions? When they are going to crystallize in the form of liabilities, so that there will be outflow of economic resources whenever they are settled, and by what amount they will be finally settled. So that is the nature, timing, and amount of the provisions. Same goes for the contingent liabilities. So what is the nature of contingent liabilities? Why they are contingent? Why they are not, recognized as provisions? So that we will see. And what are the timing and amount if there are any measurement basis. Basis on that, we need to, estimate the amount of contingent liabilities for our disclosure purposes, right? For contingent assets also, we just need to state what is the nature, why we say that these assets, these are assets for, because they are not meeting the definition of assets, but entity expects something, in future to be received. So that's why they will be assets which will be decided on certain contingent event. Okay, so that will happen in future. So that will decide whether the entity will establish the right to receive those assets or not, right? So that's why as on date they are called contingent, because they are dependent on some future event, right? Now, what would be the timing when the entity expects them to realize, and what would be the amount, and what is the nature? So these are the disclosures which we will be required to make in our financial statements. So that's the objective. Now, what is the scope of this standard? Which all types of provisions are covered? So Ind AS 37 applies to all contingencies except financial instruments, right? So if there are any guarantees, sometimes, holding company gives guarantee on behalf of subsidiary company gives, guarantee on behalf of holding company, and vice versa within the group, right? So those guarantee contracts are being accounted for under Ind AS 109. Those are called financial guarantees, right? You must have studied that under financial instruments session, right? So those are specifically covered by Ind AS 109. That's why, that is not in the scope here. Those covered by other Ind ASs. So if there is any specific items talked about by other Ind ASs, so those are also excluded from the scope of this general standard. So this is a general standard for all types of provisions and contingent assets and contingent liabilities. But if we have, a specific standard talking about a particular item, how that needs to be accounted for, and which all disclosures are required to be made, so we will refer to that standard only, and Ind AS 37 will not apply, right? For example, Ind AS 115, revenue from contracts with customers. So in this standard, you must have studied that, if there are any if there are any contract assets which needs to be accounted for under that standard, so that is covered by Ind AS 115 only. So those are not required to be covered under Ind AS 37. Similarly, income tax provisions. So we compute the income tax liability, deferred tax assets, deferred tax liabilities. So all these, income tax related liabilities, we compute in accordance with the Ind AS 12, right? So that standard is specifically covering the liability provisioning for income taxes. So that's why general provision standard Ind AS 37 will not apply to those types of liabilities, right? Ind AS 116 leases. So you must have studied that, we calculate the right of use asset and lease obligation correspondingly is recognized, right? So that lease obligation is somewhat a liability or, provision for future payable, right? So that is specifically dealt by Ind AS 116. Hence, this standard Ind AS 37 will not apply to those types of liabilities. However, if any lease contract is a onerous contract on the day one, then Ind AS 37 will certainly apply to recognize the provision for that onerous contract, right? So I will come what onerous contract means and when, provision is required under Ind AS 37 for those contracts. But for the time being, if onerous contracts are there, then those are well covered under Ind AS 37. Right? Onerous contracts are those contracts where, benefits accruing from fulfilling the contract are lesser than the obligations under the contract. So these are loss-making contracts for the entity if they go on fulfilling those contracts. So that's why, these are called onerous contracts, right? So we have to accrue a provision in our books for the, onerous contracts. You must have, already been doing it under ICAI too. So as such, there is no big difference from what we have been doing earlier. Now, Ind AS 19 employee benefits. So any benefits which are related to employee benefits, for example, short-term benefits, long-term benefits, long-term service awards, gratuities, pensions. So all these provisions, we generally account for basis on the actuarial certificate, all these long-term, liabilities pertaining to the employees. So those liabilities are still called provisions because they are not, clear amount. So they are a estimate by the actuary made as on date that what would be the expected amount to be paid by the entity to discharge these employee benefits obligations in the long term, right? So those provisions are specifically dealt by Ind AS 19. So any provisions which are dealt by Ind AS 19, right, under employee benefits are not covered under Ind AS 37. Insurance contracts, Ind AS 104. So same goes for insurance contracts. So if there are any, insurance liabilities needs to be estimated basis on the past historical experience of the insurance company, that how much, what is the claim, expectation for all the policies they have issued as on date, right? So, underwriter estimates what is the expected settlement amount that the company would be incurring in future for all the contracts issued as on date. As on date means as on the reporting date of the balance sheet, right? For example, 31st March 2023. So that estimate is, done under Ind AS 104 only for that provisioning. So that provision is not specifically, covered under Ind AS 37. It is excluded from its scope because Ind AS 104 is covering that specific provision. Contingent consideration of an acquirer in a business combination, Ind AS 103. So under Ind AS 103, you must have, studied that whenever the acquirer acquires any company, so they discharge purchase consideration. Purchase consideration can be discharged in the form of cash, in the form of assets, or in the form of shares, right? So everything is covered by Ind AS 103. Now, sometimes what happens, if the acquirer, agrees to pay some contingent consideration, right, dependent on some future event. For example, if after the post acquisition, if we are able to meet certain agreed parameters or criterias like revenue performance, sales growth, market share, whatever conditions are there, if they are fulfilled, so acquirer and acquiree agreed on the acquisition date that acquirer will pay some additional consideration to the acquiree, right? So that is called contingent consideration. So that provision for contingent consideration is, computed under Ind AS 103 and, accounted for under Ind AS 103. So that's why that specific provision is not covered by Ind AS 37. So what I am trying to say is Ind AS 37 is a general standard to cover all those liabilities and provisions which are not dealt specifically by other standards. So if anything is dealt by specifically, by other standards, then those provisions are out of scope from Ind AS 37. Is that clear? Now, the last piece is onerous contracts. So onerous contracts are, the contracts where the benefits of fulfilling the contract are lesser than the obligations under the contract. So they are loss-making contracts on the day one, right? So that's why provisions for onerous contracts has to be made under Ind AS 37, right? So executory contracts are not covered, but onerous contracts are covered. Now, we just need to understand what we mean by executory contracts and what we mean by onerous contracts with some examples. So let's do that first. We will come back to the scope. We will discuss it again. Executory contracts are the contracts under which neither party has performed any of its obligations, or both parties have partially performed their obligations to an equal extent. equal extent. Okay. For example, employee contracts in respect of continuing employment. Now, suppose if there are employees, with the company. Now, employees are on a daily basis attending the office and fulfilling the obligation they have agreed to in the employment contract, right? So employment contract says that company will pay you. You have to come to office and, do the work, whatever you are supposed to do, right? So that is the contract basically. So employees are fulfilling their part and company is fulfilling their part by discharging their obligation in the form of payment of salaries and other benefits to the employee. So this is called executory contract. Contracts for future delivery of services such as gas and electricity. Now, I have taken a pipeline for the gas in my home. Okay. Or any company has taken a gas pipeline or electricity, line in the factory, right? Now, entity and the provider of that gas or electricity company both have entered into an agreement that we will give you the gas on a continuous basis and we will bill you at this rate, and you have to discharge, our payment as and when the invoices are received, right? So this is the basic agreement between the two parties. Now, gas company or electricity company is, supplying the gas and electricity under the contract and raising the invoice. As and when the invoice is raised, basis on the payment terms, entity is also discharging their payments, right? So both the parties are fulfilling their performance obligations to an equal extent, right? So gas company, electricity company is giving the gas and electricity as agreed, and the entity, paying the invoices as and when the invoices are received, right? So both the companies are discharging their obligations, right? So these are called executory contracts, right? Where both the parties are executing their respective performance obligations. So those are called executory contracts. Obligations to pay local authority charges, etc., are executory contracts. So in nutshell, what do we mean by executory contracts? Executory contracts are those contracts where both the parties are intending to perform their respective obligations and they are doing so to an equal extent on a continuous basis, right? So those are called executory contracts. If neither of the party under the executory contract has performed, so that aspect is also, covered, because gas or electricity company is about to supply. Once they supply, they raise the bill, and then only the entity receiving the gas or electricity will pay, right? So as of now, contract is entered, but none of the party has yet started performing their obligations. So that aspect is also covered, right? So this is called executory contracts. Now, any liabilities which we need to account for these contracts, is not covered under Ind AS 137, right? So these are not covered under Ind AS 137, right? Why? Because these are specific liabilities which the entity will, discharge as and when they fulfill the other party fulfills the obligations, right? Now, what is onerous contracts? Because onerous contracts are covered under Ind AS 137, covered under Ind AS 37. Okay. Now, is the contract onerous in the first place, where unavoidable costs are greater than economic benefits, right? So if we go ahead, both the parties go ahead and fulfill the contract, then this contract will be a loss-making contract for the reporting entity, right? In that case, the reporting entity will, try to avoid fulfilling the contract, right? So what the condition is, unavoidable costs are greater than the economic benefit. Now, that is measurement at the lower of, regardless of the management's intention, cost of terminating the contract or net cost of continuing with the contract, right? So unavoidable cost means there could be two scenarios. Either I intend to fulfill the contract or I intend not to fulfill the contract, right? So if I fulfill the contract, so whatever the cost I will be incurring for fulfilling the contract is greater than the economic benefit I will be, realizing by fulfilling the contract. Number one, scenario number one. Scenario number two, even if I do not fulfill the contract, then also I am liable to pay certain damages or, cancellation charges because I'm canceling the contract now. So those cancellation charges or, damages are called unavoidable cost in the scenario two. In scenario one, unavoidable cost is the cost of fulfilling the contract. In both the cases, it is a loss making for the company, right? So that's why these are called onerous contracts. So if there are any onerous contracts, so those needs to be provided for. That is, we need to record a provision for this expected unavoidable cost, which we will be incurring either by fulfilling the contract or by canceling the contract. So that cost has to be provided for in the books of accounts on the reporting date for all such onerous contracts, right? Let's see an example. An entity that operates profitably from its current leased factory relocates its operations to the new factory but continues to pay the rent during the remaining 4-year lease term on the old factory has an onerous contract. In this case, the entity is obliged to make payments but is no longer using the asset for its business purposes. So there was a land which on which the factory has been leased from some other entity, and we have say entered into a binding contract for 10 years. Whether we use that factory land or not, we have to pay the rent. That is what the terms of the contract. Now in this case, even if company is not using that factory land for its business purposes, it is liable to make the payments for the rents agreed in the agreement. So now, because company has already shifted its operations from this factory to some other place, but still 4 years is the remaining lease period and company cannot cancel this as per the agreement. So 4 years rent has to be paid, right? Irrespective of the fact whether company is using that land anymore or not, right? So in this case, this contract now has become onerous contract because as such, company is not getting any benefits out of this land, but they are bound to pay the rents for next 4 years. So in order to complete this contract, they have to make the payments. Even if they cancel, they have to make the payments. So in either case, they have to make the 4-year rental payments. So that's why this contract has now become a loss making contract because there are no economic benefits accruing to the entity from this factory land, but they are required to discharge rent payments for next 4 years. So that's why we will provide for these rent payments, right? So what we will do to provide for, we will calculate the present value of next 4 years lease payments, right? That present value has to be recorded as a provision in books of accounts now. Now the question comes, in the scope slide, we said that Ind AS 116 leases are out of scope for this standard Ind AS 37, right? What I have mentioned, out of scope is the lease obligation liabilities, right? Which are measured under Ind AS 116. But if lease contracts become onerous contracts, then Ind AS 37 will apply. So if there are any contracts which are onerous contracts, whether they are lease agreements, whether they are non-lease agreements, or whether they are any other agreements. So if the contract is an onerous contracts, then provision for those contracts needs to be accounted for under Ind AS 37 and recorded in the books, right? Another example. An onerous contract may arise in relation to the sale of commodities when the market price declines below the cost required to obtain, mine, or produce a commodity. Okay. Suppose you know that, there are various companies who are in the extraction of natural resources, right? So they extract oil, they extract other minerals, metals, right? Aluminium, copper. So all these metals are extracted, oils are extracted and, purified and sold. Now, if company has entered into a binding sales agreement with some other entity that I will supply aluminium to you, say 100 kg aluminium every month. For example, this is the contract. And because at the time of the contract, price was agreed between the two parties for next 3 years, for example, 150 rupees per kg, for example. So 150 rupees per kg was the price agreed, right? 150 rupees per kg. Okay. This was agreed price for next, say, 3 years. Okay. Now, suddenly, after the end of 1 year, price, skyrocketed. So the price has increased, say, 200 per kg, for example. Okay. Now, because in the market, prices has shot up 200 per kg, but companies, bound by the supply contract to, supply aluminium at 150 per kg only for next 3 years. Now, cost, to mine or obtain or produce the commodity has also started, rising. And suppose earlier the cost was, say, for example, 110 rupees per kg. Okay. Now this cost also goes up, say, 160 rupees per kg. Okay. Now, if the company is extracting or producing the product at rupees 160 per kg and they are bound to supply this product to another entity at 150 rupees per kg. So it means this contract is a loss making contract by default. So every prudent company will try to avoid or, try to cancel these contracts. Now, because, benefits under this contract are falling short of the cost incurred to fulfill the contract. So this contract, qualifies for the onerous contract because these are now loss making contracts. So we have to record a provision for the expected loss amount the company will be incurring on this contract. Suppose there are two scenarios. Number one, company cannot cancel and has to fulfill, or company can cancel. So say 50,000 is the damages charges as per the clause in the agreement. If either party cancels the contract at any time, 50,000 rupees is payable by the party who is cancelling to the other party, right? So this is the damage clause. And if company goes on fulfilling, so for next 3 years, how much quantity is agreed to be supplied, that quantity, suppose X quantity, into 10 rupees per kg, right? So this will be the amount. Suppose say 100 kg is the amount quantity, then 1000 rupees, right? So 1000 rupees would be the expected loss. Now, in this case, if company cancels the contract, it will have to pay 50,000. If company fulfills the contract, it will have to incur a loss of 1000, for example. Now, in this case, provision will be recorded for 1000 rupees because a company will, definitely opt the option one only, that is to fulfill the contract in spite of the loss making. So 1000 rupees is the expected loss to be made by the company that will be provided for provision for onerous contract, right? Now, if this 1000 rupees has to be incurred within next 12 months, then no discounting. And if it is to be, incurred after the 12 months from the reporting date, then discounting will also come in. So there is a big difference between IGAP AS 29 and Ind AS 37. Under IGAP, we have never used discounting for, provisions estimate, right? So under Ind AS 37, whenever any obligation is to be discharged after 12 months from the reporting date, that has to be discounted at the appropriate discount rate. So that we will discuss in the session going forward. But just for your, information, whenever contracts are expected to be, discharged after 12 months from the reporting date, discounting has to be applied, right? So this is how the onerous contract provisioning we need to estimate and record. Let's go back to the scope slide. So here as well, there is an exception. So I said that revenue from contracts with customers, any provisions are not required to be, recorded under Ind AS 37, but except for onerous contract. So whenever there are onerous contracts for any of the standards, for example, it may be for the revenue contracts, it may be for the lease contracts, it may be for other contracts too. So onerous contracts are covered under Ind AS 37. Right? Any doubts on the scope? So Shruti is asking any example for onerous contract. I think I have discussed 2 examples. Hope that is clarifying the concept. Let me know any questions, doubts, queries, concerns. Okay, thanks, Shruti. I'm just waiting for 30 seconds because I know whenever you post the message, it reflects after some time lag in this application. So it takes usually 30 seconds. And if no doubts, at least you can say clear or no doubts so that I can proceed. Okay. Now, there are certain key terms used by the standard, which we need to understand first before we, jump on the requirements of the standard. So what is meant by a liability? So we have been using this term, since ages now, but, we need to understand how this is defined by the standard. So a liability is a present obligation arising from the past events, right? So these are the keywords which I have highlighted in bold and underlined them. So present obligation arising from past events. Okay. The settlement of which is expected to result in an outflow of resources, right? These outflow of resources may be in any form. For example, cash, shares, other assets, right? I can discharge these liabilities, by any of the means. Either I can pay cash, I can issue equity shares, I can pay certain other assets. For example, if I'm falling short of cash, I can agree that, okay, you take my machinery from the factory to discharge this obligation. And if the party agreed, they will take, the machinery. So I can discharge by any outflow of resources. So resources can be of any form, right? Embodying economic benefits. Provision. Now this is the another term. So this is the liability and this is the provision. So liability we have understood present obligation from past events resulting into outflow of resources, right? So three keywords: present obligation from past events resulting into outflow of resources. That is called liability. What is the provision? Provision is a liability. So standard is saying, boss, provision is a liability, but of uncertain timing or amount. So either the amount is not crystallized yet, that how much is payable, or if amount is known and crystallized, timing is not known when it is payable, right? So when any of the item is a variable, either the timing or the amount, either the timing or the amount is variable, then this is not called a liability, but this is called provision. Clear? So what is the difference between a liability and the provision? Liability is present obligation arising from past events with known amounts of outflow of resources. How much is payable and when it is payable is clear. And this is a present obligation that has to be discharged. So this is called the liability. And provision is one of the form of liability, because provision in, of course, will become liability at some future date. Today it is provision, but it will be liability as and when either the timing, which is not confirmed yet, gets confirmed, or the amount, which is not yet known, gets, cleared. So timing and amount are not known, but there is a certainly, some outflow of resources would be required. So that is called the provision. So provision is a liability with some uncertainty around either timing or the amount, right? So provision is equal to present obligation from the past event plus outflow of resources is probable plus reliable estimate can be made. Getting my point? What is the difference between the liability and the provision? So liability is a present obligation, right? Provision is also a present obligation. Liability is a present obligation arising from past event. Provision is also a present obligation arising from past event. So till now, liability and provision are same. Now, liability results in outflow of resources which are known and timing is also clear. Here, outflow of resources is probable, right? And amount is uncertain. So we are estimating reliably on some basis or assumptions, but the amount is not clear. It may change. For example, when we say that provision for, XYZ item, now later on the invoice comes. So whatever the provision we made, we generally reverse that provision and record the invoice, right? But until the invoice, came, we were just estimating basis on our best judgment, how much amount the supplier is going to bill us, right? On some assumptions. But actual invoice amount may turn out to be a little different, right? So amount is uncertain, but there is as such no uncertainty around whether it will be invoice will come or not, because we have taken the services. It's just a matter of fact, we do not know how much, we need to record as a liability. That's why we have provided for, right? Basis on our best estimate. So that is the difference between the liability and the provision. Probable means more likely than not, Yukta. So more likely than not. Now, the next question comes, what do you mean by more likely than not? It means greater than 50% of chances of happening something. So more likely than not. So equal probability is 50-50. But if I say more likely, then it means greater than 50%, right? Greater than 50%. Greater than 50%. Chances of happening something. So that is called probable, right? So Yukta is asking if we are settling any liability under in the form of shares by issuing shares. So will it be covered under Ind AS 102? Now, the question here is, when we discussed the scope of Ind AS 102, what we have discussed? Ind AS 102 says share-based payment arrangements, right? Or share-based payments. So if we have entered into an agreement with the supplier that boss, you supply this raw material to us worth rupees 5 lakh and we will issue shares worth rupees 5 lakh to you. So that is called the share based payment arrangement, right? But if there is as such no agreement there, right? And it's a matter of fact, at the date of the settlement, we just said that because we are falling short of cash, we can, issue equity shares to you. And he agreed. So still, this is a share-based payment transaction only because we are now discharging, the liability by issuing the equity shares. But, it will not be a full-fledged, share-based payment transaction to be recorded under Ind AS 102 because there were no vesting period, because all the periods have already been passed. It's just a matter of payment on the date of payment, right? So as such, all those vesting conditions, vesting period will not be there. But yes, on the date of payment, because I am issuing equity shares, so that is a share-based payment. So disclosure for this, issuance of equity shares for discharging any liability will be required to be made under Ind AS 102. So Yukta is saying probable means chance of discharging liability as we studied in AS 29. Correct. So probable means more likely than not when the chances of discharging a liability or, incurring a liability are more than 50%. Right. So that is called probable. So provision is a liability of uncertain timing and amount. Right. So that's why, it is called probable liabilities. Provision. Provision is a liability of uncertain timing and amount. Any other questions? Okay. Let's do quickly this question. ABC Limited is an automobile component manufacturer, right? The automobile manufacturer has specified a delivery schedule, non-adherence to which will entail a penalty. On 31st March 2001, the reporting date, the manufacturer has a delivery schedule for June 2002, right? So delivery is to be made in June 2002. Books are being prepared for 31st March 2001, right? And if manufacturer fails, manufacturer is required to pay a penalty. Okay. However, manufacturer is aware that he will not be able to meet the delivery schedule in June 2002. Determine whether the entity, that is the manufacturer, has a present obligation as at 31st March 2001 requiring the recognition of the provision. So we need to say, for example, if the penalty amount is say rupees 50,000, now you just tell me whether provision is required to be recognized for 50,000, yes or no. So Pradeep is asking, provision is compulsory or optional? See, provision means we know there would be certain obligations which entity will be required to discharge, but because we do not know when they are expected to be discharged or by what amount they will be discharged, so that's why we are making an estimate as on date and recording a provision in our books. So it is not provision is compulsory or optional. Provision is not optional. Provision is compulsory for all those liabilities which are to be discharged by the entity in future. Kushma is saying, since it is probable, we need to recognize. Okay. You are saying 50,000 provision we need to recognize. Muhammad is saying discounting rate has to be applied. Arre, forget about discounting for at this moment. When I come to the concept of discounting, thereafter you factor in those. Until then, you just keep it, in the parking. So as of now, you just let me know whether 50,000 is to be recognized as provision or not. Pradeep is saying yes, recognize. Okay. See, please try to answer, because if you are making mistakes in the classroom, it will help you, to avoid those mistakes in the examination. Because we remember our mistakes. So Shruti is saying yes, Muhammad is saying yes, Kushma is also saying yes. Okay. In this case, there is no present obligation arising out of the past event, as the goods are scheduled for delivery in June 22 and there is no delay happened as on 31st March. Hence, there is no present obligation to pay the penalty in the current year. Therefore, there is no present obligation to recognize any provision. Now, let's get back to our definition. I said provision is equal to present obligation from past event. Present obligation from past event, not from future event. If delivery is expected to be scheduled in June, I am preparing the accounts for March and I anticipate that I will not be able to fulfill the delivery. But still, this is not a past event. This is a future event, which will be, default or no default will be decided only once I reach to that date. So on that date only, I will be either defaulted or, compliant. I cannot say I am defaulted on 30th June, sitting on 31st March, right? On 31st March, I cannot say I am defaulted. I still have 3 months to, do whatever I can do. So as on 31st March, event has not yet occurred. What is the event here? Default to deliver. So default to deliver is the event which has not yet occurred. So there is no past event. Because there is no past event, so certainly there cannot be any obligation, because there is no event as such as of now, right? So since this clause does not meet, hence no provision is required. So Mr. Yedu Kondulu is correct. He said we will recognize the provision for 2002, matlab in the year 2002 only, not 2001. I agree. So in 2002, while I will be preparing the financials for 2002, that is March 2003, right? So for that financial year, because it is now a past event, I have defaulted, hence I need to provide for. There is identification of delay in delivery as on the date of provision should be created, right, sir? Okay. See, when there is a definition and definition is clearly saying that provision means present obligation from past event. So if event has not yet occurred, so there is no past event. Since there is no past event, so there cannot be any present obligation. Right. So if I know that I will default on 30th June, but on 31st March 2001, I cannot provide for all the future losses or future defaults, which I think I may be incurring, right? If that is the case, then there is a, open avenues to record any future, events or incidents which will happen in future, to record it now. So suppose if, I can say that rains can come and damage my factory. say after 6 months. So should I record the provision now? No, because event has not yet occurred. So once the event occurs, then only, obligation arises. Am I clear? For March 2003, it's a past event, correct? No, no, no. For March 2003. Okay. So in June 2002, which will be falling in the financial year March 2003, right? So in June 2002, date has already been passed and I have defaulted. Past event is complete now. That is, the default has been done by the manufacturer. So while preparing the financials for March 2003, it is a past event resulting into an obligation to pay rupees 50,000 to the other party, right? So 50,000 becomes payable to the party because default has already been done. So on the date of default only, you have to record this provision for 50,000. Clear, Shruti? So Anand said yes. Okay. Examples of past events which lead to present obligation. In respect of warranty provision, it would be the original sale. Yes or no? Yes. If I have not yet made the sales, then can I recognize the warranty provision? अभी तो sales ही नहीं हुई. I have not yet made the sales, then I cannot recognize the warranty provision. Warranty provision can only be recognized once the sale is made. Suppose my historical data says if I sell, goods to the customers, 5%, comes as defective and they are returned, or, customer asks for a, replacement, rework, or, correction, whatever. So that 5% estimate provision I have to make on the sales made. But if I have an order packed in my godown, but I have not yet dispatched that goods, I have not yet invoiced those goods to the party, right? So can I make a provision on my in-house inventory? No. So warranty provision only becomes a present obligation arising out of the past event. Past event is the sales. So once the sale is recorded, sales are made, sale is recorded, then only warranty provision needs to be recorded, right? So original sale is the past event, which will gives us present obligation for warranty provision, right? In respect of contamination of land, it would be the original contamination. So suppose if I have taken the permission from the government to extract oil from, in some area, now only permission I have taken, and government has, laid down a condition that, boss, if you contaminate the land or the environment, you will be, liable to pay these environmental penalties. Okay. But I have not yet started extraction. I am just, keeping the permission letter with me. Does this mean that I need to record for the provisions for the contamination of the land? No. Once I start the extraction and that extraction actually results into contamination of the land, then only I will, record the provision for contamination liabilities. Getting my point? So past, please focus on past event, whether the past event has occurred or not yet occurred. If past event has occurred, then only it gives rise to the present obligation to discharge the agreed liability or penalties or damages, whatever, for those events, right? In respect of provision for dismantling or cleaning the oil rig, it would be when the oil rig is first built. So same thing. So if I have taken the permission to extract the oil from the seabed, but I have not yet, digged the seabed and, fixed the oil rig into that. So until then, I cannot be liable to dismantle what I will be dismantling, which I have not yet fixed in first place. So once I have fixed the oil rig in the seabed, then only the provision for dismantling the oil rig at the end of the oil rig's life is, becoming applicable, right? So until and unless I fix the oil rig, I cannot be asked to dismantle anything, right? Getting my point? I hope this concept is now, more clear after having these three examples. Clear? Let's do one more. The government introduces a number of changes to the income tax system. As a result of these changes, an entity in the financial service sector will need to retrain a large proportion of its administrative and sales workforce in order to ensure continued compliance with the new provisions of the Income Tax Act. Okay. So they need to train their employees so that, a company is not non-compliant with the new provisions. At the end of the reporting period, no retraining of the staff has yet taken place. It is assumed that a reliable estimate can be made of the outflows expected. Do we need to record any provision in this case? If yes, what would be that provision? If no, why so? We need to stick to the definition and the keywords which we have understood and analyze the circumstances given in the question based on that instead of on our, intuitions. Presence of past event and outcome is an integral part of that past event. The provision will be made as per Ind AS 37. Okay. So Tariq Ahmed is saying there is a presence of past event. So provision will be made. Okay. Muhammad is saying since no retraining has been started, there is no need to recognize any provision. Okay. Anantha Krishnan is saying provision should not be created because the event of retraining the staff has not yet taken place. Okay. Present obligation as a result of past obligating event. There is no obligation because no obligating event, retraining has taken place. No provision is required to be recognized in this case. Correct? Now, suppose if the entity would have entered into an agreement with some other entity to retrain, to provide, training to the employees of the entity, and that entity started doing so. So they have, started doing sessions, workshops, or seminars. Then probably in that case, because training sessions are done, so basis on that, entity would be required to recognize the provision basis on how much service has been delivered by the training institute, right? So in that case, we would have recognized. But now, as in this case, till 31st March, because there is no event taken place for, giving any sort of trainings to the staff, hence there is no liability, right? So that we have already understood that a provision is a liability of uncertain timing or amount. right? So either the timing is uncertain, that is when it is required to be discharged, not yet confirmed, or by what amount it will be discharged, not yet confirmed. But certainly one thing is confirmed, that something will be discharged. That is for sure, right? Now, what is the recognition criteria for the provisions? So this, flow chart will clear how and when we need to recognize the provision. First question, is there a present obligation, whether a legal or the constructive? So I will come to these legal and constructive aspects for an entity. If the answer to this question is yes, then next question, has the present obligation occurred as a result of the past event? So it means the other way around, I can say whether the past event occurred. If the past event occurred, then definitely there will be present obligation arising. If the past event not yet occurred, then there wouldn't be any present obligation, right? So the question is there a present obligation on account of legal or constructive obligations? If yes, whether the past event has occurred, if the answer is yes, is there a probability that the outflow of resources will be required to settle the obligations? So past event has occurred, but company believes in spite of the fact past event has occurred, we are not expected to, pay anything. So if the outflow of resources is not expected, then no provision. If answer to this question is yes, we are required to discharge. So this something we have to discharge. So outflow of resources is probable. Probable means more likely than not. That is more than 50% chances are there that we will be required to pay something to the other entity, right? If the answer is yes, then can the entity make a reliable estimate of it? So if it is not possible to estimate it reliably, then by what amount I will post the journal entry? So in the absence of reliable estimate, I will not be required to record the provision because I do not know how much amount I need to record. Unless and until that is known, I cannot post the journal entry, right, in the books. So the last question is whether the reliable estimate can be made or not. If reliable estimate cannot be made, then again provision will not be recognized. But if yes, reliable estimate can be made, then we will recognize the provision. Clear? So this is the basically flow chart which should be there in our mind whenever we assess any situation or circumstance from the objective of deciding whether any provision needs to be recognized or not. So these are the questions which should be there in our mind, right? So 1, 2, 3, and 4. These are the 4 questions. And basis on the answers we are, getting on these questions, we will decide. If any of these fails, then provision will not be recognized. Clear? Any doubts? Please try to be responsive in the chat box as quickly as possible so that I know we are on the same page and we are not leaving anybody behind, struggling with some understanding. Clear? Okay. So Muhammad Shruti Kushma, thanks for the confirmation. Now, another term, obligating event. What do you mean by obligating event? Obligating event is an event that creates legal or constructive obligation which results in an entity having no realistic alternative but to settle the obligation. So obligation can come from past event, right? Right? That we have already discussed. Now, this past event can occur because of some legal obligation or because of some constructive obligations. So legal obligation means when the obligation is driven by contractual arrangement. Contractual agreement, right? So if there is a contract between two parties, so that is called legal, because if the party defaults or does not fulfill the contract, the other party can sue in court of law, right? So that's called legal obligation. Or by legislation or other operation of law, right? So those are called legal obligations, right? Obligating event will be called legal obligating event if the event is, arriving because of the contractual agreement or the legislation or other operation of law. Now, suppose there is an environmental law which says that if you have, used any of the area for extraction of mineral resources, then after the life of, extraction ends, you need to restore that site or, rehabilitate that site, right? So there is a law. So because of this law or legislation, there is an obligation on the company that to restore the site, to restore the seabed, to dismantle the oil rigs, right? Whatever they have done, they have to make it as good as it was when they received, the site from the government, right? So this law, if such law is there, then this law makes the entity accountable for these obligations, right? So that's why this law is giving an obligating event, right, for these types of activities. If law is not there, okay, but while taking the permission from the government, the contract with the government has been signed, and there is a condition that whenever the extraction process gets completed, say after 10 years or 20 years, the company needs to restore the site. So that is the contractual driven condition. So in that case, this contractual condition will become the obligating event, right? So both these are classified as legal because either it is driven by contract between two parties or it is driven by some legislation or law which is already there, right? Another case or scenario, when the obligating event is coming out of the constructive obligation. So constructive obligation means established pattern of past events, past practice, published policies, and sufficiently specific current statement. So suppose entity in the past has taken the permissions from the government and, extracted the mineral resources and restored the site. Okay. So this is the established practice. Although there is no condition laid out in the permission letter, nor there is any law. So as such, there is no legal, obligations or no legal event around that, but still company is doing so. So this means this is a constructive obligation. So whenever the company gets new permissions, they are expected to, fulfill or, that, obligation, that is to restore the beds or the sites, right? So this is called past practice. So this is although not legal, but this is constructive. So again, if constructive obligation is there, that will also give rise to the present obligation, right? Published policies, company on its website or, memorandum of association, article of association, or anywhere on the bulletin board, published that whenever, they, take the, any site, from the government or from any private party, they always ensure whenever they hand them back, to the party, they are in the same state of condition as they have received. So this is a published policy of the company. Again, this is a constructive obligation. Or sufficiently specific current statement. Company has made a current statement that they will do this. So that is again a constructive obligation, although that is not part of the agreement. So these are called constructive obligations, right? So we will do quick examples. I know it is the time for break. Generally, you have it somewhere around 8:15, 8:30. So let's complete these examples and we will have a break. Example of legal obligation. X Limited entered into a contract with Y Limited for supply of some material. As per the terms of the contract, in case of breach of contract, the party who breaches the contract has to pay 50 lakh rupees to the other party. So 50 lakh is the penalty amount whoever breaches the contract. X breached the contract with Y. Now, in this case, obligating event is the breach of the contract. Until the contract is breached, there is no past event, right? So once the contract is breached, then only past event has occurred, which give rise to the present obligation, and X Limited must settle the obligation. So in this case, regarding the breach of contract, X Limited is required to record a provision of rupees 50 lakhs because they have breached the contract, right? Clear? So this is the legal obligation example. This is the constructive obligation example. X Limited is engaged in the manufacture of fertilizers. Effluents discharged in the manufacture process polluted river near the manufacturing plant. The residents of the nearby locality launched a massive agitation against the pollution. X Limited agreed to their demands to reduce the water pollution by installing the necessary effluent treatment plant. However, during the year, no steps are yet taken to install the plant. No legislation requires the company to reduce its pollution is in existence. In this case, though there is no law, but by promising to take steps to reduce the pollution, X Limited has created a valid expectation on the part of the public that it will discharge its responsibilities. So obligating event in this case is a constructive obligation. So as such, there is no contract, there is no law, but still, because company has promised to the locality that they will install some machinery or plant which will result into reduction in the pollution going forward, and they are not fulfilling that. So constructive obligation is there, hence provision will be required to be recorded for the any expected damages company would be liable to pay if locality goes in the court of law, right? So that estimate needs to be made. So as such, at this stage, we are not saying that provision will be recorded or not, but we are saying constructive obligation is there, right? Constructive obligation is there. Provision will be recorded or not, that we will discuss once more facts are available. But basis on these limited facts, constructive obligation is there, right? Constructive obligation is there because company has promised the locality. Give me a second. Let me plug in the charger.
Okay. Another example, an entity has prepared a formal plan.
An entity has prepared a formal plan for reorganization involving site closures and redundancies. The plan has been approved by board at the year end. But the entity will not implement or announce the reorganization until after the year end. So in this case, although the plan has been approved by the board, but it is not yet started being implemented or announced. So as such, there is no constructive obligation at this stage, right? Because this is an internal matter of the company that they are, planning to do something, and, they have already taken the approval even, but they have not yet announced it. So unless and until something is announced, that cannot cast a liability on the part of the company. For example, company, announces certain types of, say, for example, bonus. So company announces the bonus, right? For all its employees. Then, it records the provision for the bonuses. So unless and until the announcements are made, or, unless and until the company is, expecting them to deliver or pay or, settle in future, there is no past event until that date, or no obligation, constructive or legal, until that date, right? Even if there is an announcement after the entity's year end, but before its financial statements are approved. So even if company announces, such announcement after the year end, that is after 31st March, but before the financial statements are approved, even in that case, there wouldn't be any constructive obligation on the part of the company. The announcement is a non-adjusting post-balance sheet event. So you must have studied adjusting non-adjusting events standard as well. So in that standard, you must have studied that, whenever the events are adjusting events, so they are required to be provided for, right? Whatever the liabilities, we anticipate we will be incurring, we need to, estimate them and record a provision. If the events are non-adjusting events, then no liabilities are to be provided for. No provision is required. Only a disclosure is required in the financial statements, right? So in this case, this is one of the example of non-adjusting event, because there is a formal plan for reorganization and restructuring or site closures and redundancies. So, right, so some internal restructuring, reorganization is about to take place, but as such, no steps yet taken by the company to initiate that process. So there is no past event, right? Even for that matter, company has not yet announced it, right? During the year end. So there is no constructive obligation even in that case. Because why it is so? The entity could change its plan completely after the year end, right? So until the announcements are made, company has all the rights to make any changes in the plans. They can withdraw them completely. They can modify, significantly. So, right. So unless and until these are announced within the year end, there is no constructive obligation. A constructive obligation would exist if the entity has raised a valid expectation in those affected by beginning to implement the reorganization by the end of the year. For example, by scrapping the plant or informing the employees that we are going to shut down the plant, your jobs will be affected, you will be laid off, and the suppliers that we are not going to continue with this business. We are planning to shut down our plant. So going forward, we will not be needing any raw materials from you. Hence, if there are any long-term contracts, companies started renegotiation of those contracts for cancellations, right? So when the company takes such steps, then only it is required to, to be said that certain provisions or liabilities needs to be recorded for. Until and unless those steps are initiated, the plans can be even abandoned complete, your gestures. So if the company has not yet made any announcement, so it means there is no constructive obligation. Let's do an example. A retail store has a generally known policy, okay, of refunding purchases by dissatisfied customers. So if the customers are dissatisfied, customers can, return the purchases made by them to the company, even though it is not under legal obligation to do so. So company is not required to, accept the returns, but because they have this policy available on their website. So this is a general known policy, right? In these circumstances, sale of its products give rise to a constructive obligation because the entity, through its reputation for providing refunds, has created a valid expectation on the part of customers that refund will be given if they are dissatisfied with their purchases. Now, for example, I hope you must have been doing shopping on various, online platforms like Amazon, Flipkart, Myntra, all these platforms. And, with a single click of button on the app, you can return any of the products you have purchased within that, of course, within the time limits, right? So they have, set this expectation with all the customers that once you receive the goods, and if you are not finding goods satisfied for, suppose if you have bought a shirt and you did not like the fabric of the shirt after purchasing it, because you are doing online shopping, you cannot, touch the fabric before you purchase. So company, is accepting the refunds or processing the refunds and accepting the returns from you because you are dissatisfied. So that is a general practice these online shopping, apps are following. So they have set this expectation with all their customers. So hence they are supposed to make an estimate of their expected returns basis on the sales made, basis on their some historical data, and they need to record a provision for, sales returns accordingly in their books of accounts, right? So this is called constructive obligation because they are behaving in certain way for past some time. Hence, they will be required under this standard to record a provision for similar acts, right? Any doubts? So we will be discussing numerous circumstances and cases during the session. You just let me know if you have any doubts, because every time there will be different situation, different circumstances, right? So if you are able to understand, fine. If you are not, then let me know. I can repeat. Please let me know in the chat box. Clear? Any doubts, questions? Okay. Now another example, another scenario. Okay. Legal requirement. What is the obligating event? Legal. So this is either driven by contract or driven by law, right? That is called legal, right? Legal requirement to fit smoke filters. Now, under the new legislation, so some new law is, implemented. An entity is required to fit smoke filters to its factories by 30th September 2001. So on or before 30th September 2001, factories are required to fit smoke filters, right? As you know, there is a lot of pollution happening in Delhi during these days. So if all the nearby factories, surrounding states by Delhi are asked to fit smoke filters, so whatever, their chimneys, are creating a pollution. So if they are required to fit smoke filters by this legislation on or before 30th September, the entity has not fitted the smoke filters. Now, law is saying, boss, you fit the smoke filters in your factories by 30th September. The entity has not yet taken any action on that. It is assumed that a reliable estimate can be made of any outflows expected. Right now, as at 31st March 2001, at the end of the reporting period, what do you think? Will there be any obligating event? Yes or no? If there is, then whether the provision is required or not. So, present obligation as a result of past event. That is what we need to understand. Present obligation as a result of past event. Now, date by which the company can take action is 30th September. We are preparing the financials of 31st March 2001, right? So we have still 6 months to go, right? So we have not yet defaulted, right? So there is no obligation because there is no obligating event, either for the cost of fitting the smoke filters or for the fines under the legislation. Hence, what is the conclusion? No provision is recognized for the cost of fitting the smoke filters. Why? Because we have not yet defaulted under the law, so we are not required to pay any fines, at least as on this date, right? And since we have not initiated any steps in fitting the smoke filters, so no provision for that expense is also required because we have not yet, initiated that activity for which expense will be incurred. So neither the provision for the expected expense nor the provision for the expected penalty will be recognized as on 31st March 2001 because obligating event is not yet past. That is, there is no past event, right? Now, as at 31st March 2002, at the end of the reporting period, what will happen? Present obligation as a result of past event. There is still no obligation for the cost of fitting smoke filters because no obligating event has occurred. That is the fitting of the filters. However, an obligation might arise to pay fines or the penalties under the legislation because the obligating event has occurred. That is the non-compliance with the law, right? So there are two activities. Number one, whether the company has initiated the process of fitting the smoke filters. No. So there is no obligating event for that because no past event, right? But because the date of 30th September by which smoke filters should have been fitted by the company as per the law is past. So company has defaulted. So past event has occurred. What is the past event? That is the default. So default is the past event. So provision for penalties or fines under that legislation needs to be recorded in the books of account as on 31st March 2002 financial statements, right? Is that clear? Now, as the outflow of economic resources embodying economic benefits in settlement, assessment of probability of incurring fines and penalties by non-compliant operation depends on the details of the legislation and stringency of the enforcement regime. Now, sometimes it happens that there are laws in place and people are defaulting, but still government is not imposing penalties, right? And historical record says that government is not imposing penalties on the defaulters. So in that case, do we need to make a provision? Yes or no? So we have defaulted, but past history says whoever defaults under this particular law, are not yet, made liable to pay any sort of penalties. So law is there, that is implemented, but nobody is monitoring, right? If nobody is monitoring, so there are no penalty notices coming to any of the parties or entities who are defaulting. So now the entity wants to understand from us whether any provision is required in this case or not. So in this case, provision will not be required because as such, it is not expected that outflow of resources will be there. So let's get back to our flow chart. So this flow chart, we have to, master. Is there present obligation? Yes. what is the present obligation? Default, right? And this default is because of legal obligating event, right? Has the present obligation occurred as a result of past event? Yes, default has occurred. So past event has occurred. Yes. Is there a probability that the outflow of resources will be required to settle the obligation? No, there is no probability, because there is no case where the government has, levied these penalties on any entity so far. So probability is not there. So in that case, we will not record the provision in spite of the fact there is a obligating legal event, in spite of the fact there is a past event, that is the default, right? But because probability is not there, we will not record the provision. Now, to assess the probability, what we have done, there is further twist. We have hired a lawyer and, took his opinion. Lawyer said, boss, in the past, I understand that, government has not levied the penalties under this particular law. But now, because the pollution is the prime concern in the country, government focus is now shifting towards, levying these penalties even for the past years. So those all entities who have not yet been levied any penalties so far will, come in the coverage this year, because company has set up, the government has set up a committee to, see who all are defaulters in the country or the state, right? So please be careful. Now, lawyer will not say you record provision or you don't record provision. Lawyer will say what would be the expected outcome. So lawyer saying that it is expected that you will be receiving the notice, right? Now, whether the liability needs to be recorded, provision needs to be recorded. Yes, because now the probability is there. So we can say that basis on the confirmation from the lawyer, we, there is a chance, more likely than not, that is, there is a probability of getting the penalty notice. So this condition is fulfilled. Now, next condition. Can a reliable estimate be made? Now, for fulfilling this condition, what we need to see, are there any, penalty amounts prescribed in the law? If yes, that if you are, found default under the law, you will be charged, say, 5 lakh rupees. Okay. And on a daily basis, say 10,000 rupees. So from 30th September till 31st March, how many days? 180 days. 180 days into my 10,000 plus 5 lakh one time. So 5 lakh one time plus 180 days into my 10,000, right? So this would be the estimate. Yes or no? Yes, this would be the estimate. So in this case, estimate is reliably made. Yes, we can make the estimate reliably. So recognize the provision. But suppose, what if the law does not prescribe what amount will be levied and how the calculations will be made for the penalty, and the notice has not yet arrived, right? So in that case, we do not know how much penalty government is going to levy, and because government has not yet levied these penalties in the past, so we do not know what was that amount which has been, levied in the past on other entities. So as such, to the best of our judgment, what we can see, we will go back to the lawyer again. We will ask, sir, please let us know, although we understand that you are saying that government is, working on this law and they will soon come up with the penalty notices. But do you think, or do you know what amount they are going to, levy in the form of penalties on the defaulters? Lawyer said, although, I do not know the exact amount, but because by drawing a reference to other similar laws, this would be the expected amount. Say, lawyer says, the reference from some other law can be drawn in this case, and, this would be the expected amount. So that expected amount, now we are able to estimate. Yes. So we will record a provision. If the lawyer says, no, I even do not know the amount, and it can be any XYZ amount. So because I cannot make a reliable estimate, I have taken the professional advice as well from the lawyer, right? And still I am unable to make the reliable best estimate. In that case, I will not record the provision. Getting my point? So this is how we need to, check on all these conditions, and we will conclude whether the provision is required or not. So provision is required or not is the end output of this tree. So first is obligating event is there or not, then past event is there or not, then probability is there or not for settling the liability, then estimate is there or not. So these are the four conditions. If all the four are satisfied, then only provision is required, right? SK Tariq is saying, sir, we follow substance over form in that case, as past trend shows that no penalty is imposed, right? So if in the past there is no history of levying this penalty, then definitely we can conclude that government is not, going to levy anything, and hence there is no present obligation. Although past event has occurred, but that past event already occurred is still not, giving us any present obligation. So this is how we need to make the assessment in all the cases. So now, what is the final conclusion in this question? No provision is recognized for the cost of fitting smoke filters. However, a provision is recognized for the best estimate of any fines and penalties that are more likely than not to be imposed, right? So probability we need to assess, and then measurement we need to assess. If probability fails, no provision. If probability pass but measurement fails, no provision. So all the four has to be a pass to recognize any provision, right? Any questions, doubts, queries? And if it is clear, just confirm in the chat box. Please say yes, no, whatever. Okay. Another example. Refurbishment costs. No legislative requirement. So there is no law requiring these costs to be, incurred by the company, right? Now, what are the facts? A furnace, blast furnace, has a lining that needs to be replaced every 5 years. So every 5 years, this blast furnace lining needs to be replaced for some technical reasons. Okay. At the end of the reporting period, the lining has been in use for 3 years. It is assumed that a reliable estimate can be made of any outflows expected. So every 5 years, it is replaced. 3 years have already been passed. So after 2 years, it will be replaced. That is clear. Now, do we need to record any provision in this case? So present obligation, we will check whether there is a present obligation as a result of past obligating event. There is no present obligation. Conclusion, no provision is recognized. Why? Why there is no present obligation? When we know in advance that every 5 years it needs to be replaced. So why there is no present obligation? Because the cost of replacing the lining is not recognized, because at the end of the reporting period, no obligation to replace the lining exists, right? Because it has to be replaced when? After 2 years. So at the end of this year, there is no obligation to replace, right? Of the company's future actions. To replace lining exists independently of the company's future actions. Even the intention to incur the expenditure depends on the company deciding to continue operating of the furnace or to replace the lining. Instead of the provision being recognized, the depreciation of the lining takes into account of its consumption. That is, it is depreciated over 5 years. The relining cost then incurred, that is after 5 years, are capitalized with the consumption of each new lining shown by the depreciation over the subsequent 5 years. Have you studied in year 16 property, plant and equipment? So there you must have studied two concepts. Number one, componentization. Number two, part replacement cost. So whenever any parts in the property, plant and equipment are being replaced at, every uh, some at some frequency, say 3 years, 5 years, 10 years, so that part is capitalized and depreciated over that part's useful life. That is called componentization, right? So same thing is here. So the furnace is a larger property, plant and equipment, and it has a smaller part, that is lining, which has a useful life of 5 years. So for 5 years, it is already being depreciated, and once the 5 years ends, the old lining will be replaced with the new lining, right? So the new lining cost, say, suppose if that is say 10 lakhs or say 1 lakh, okay. So that 1 lakh will again be capitalized to the furnace, and that 1 lakh will be depreciated over again next 5 years, right? So it is well capturing the cost of the consumption of this lining, right, in the form of depreciation. So hence, no separate provisioning is required under Ind AS 37, because this is already being done by Ind AS 16 in the form of depreciation. So suppose if the furnace has the expected life of 20 years, right, and this part lining has the life of 5 years, right? So in Ind AS 16, what you would have been doing? So furnace would have been depreciated on 20 years life, and lining over the 5 years life, right? Once the 5 years expired, new lining comes in, and then again 5-year depreciation will be started on that. That is what you must have studied under Ind AS 16, right? So hence, in this case, under Ind AS 37, we will not be recording as such any provisions for any of the parts which are already being depreciated under Ind AS 16 over their respective useful lives. Clear concept? You can note these down for just your future reference, that Ind AS 37 does not require provision for part replacement in PP&D. Part replacement in PP&D, which is being depreciated under Ind AS 16. Getting my point? So this is the conclusion. So this is one of the circumstances. There could be n number of circumstances. You just need to stick to the rule. If that is being replaced or covered in the form of depreciation under the Ind AS 16, so Ind AS 37 provision will not be required. Clear? Now, Abhi, what we have discussed, refurbishments cost with no legislative requirement. Now, refurbishments cost with legislative requirement. An airline is required by law to overhaul its aircraft once every 3 years. Okay. It is assumed that a reliable estimate can be made of any outflows expected. Now, in this case, whether any provision is required. So first we will check whether there is a present obligation as a result of past event. There is no present obligation as a result of past event. Hence, no provision is required. Why? The cost of overhauling aircraft are not recognized as a provision for the same reasons as the cost of replacing the lining is not recognized as a provision in the previous example on refurbishments cost. Even a legal requirement to overhaul does not make the cost of the overall liability, because no obligation exists to overhaul aircraft independently of the entity's future actions. The entity could avoid the future expenditure by its future actions, for example, by selling the aircraft before the overhaul, becomes applicable. Instead of a provision being recognized, the depreciation of the aircraft takes into account of the future incidents of maintenance cost, that is an amount equivalent to the expected maintenance cost, is depreciated over the 3 years. Yes, I'm coming to the break, Mohammed. I was just trying to complete the examples for this concept so that after the break, we will come fresh for separate, different concept. So this case resembles with the previous case we discussed. So be it a legislative requirement or be it not a legislative requirement, right? So that is not the point of discussion. The point of discussion is whether the replacement cost or overhaul cost is being depreciated under India 16 separately over its respective useful life. If the answer to this question is yes, then that is already being captured in the form of depreciation. And as and when, new part comes in, it will be capitalized and again start depreciating, or the new overhaul, expenditure is incurred, that is again, will be depreciated over the next 3 years. So we have to be, very clear with the fundamentals. Instead of jumping to the conclusions, yes, this is seeming that cost will be incurred, so hence let's book a provision. And because it will be incurred after 3 years, so let's discount that as well. Because for more after, if any provision is any liabilities to be discharged after 12 months from the reporting date, discounting becomes applicable. So people may say that, because it is a 3 years life, so we will make an estimate, then discount it at appropriate rate and record a provision. But that accounting is wrong, because that is already being captured by Ind AS 16 in the form of depreciation. So Shruti is saying, sir, you note that PP thing is covered in the scope exclusions. Sir, why not? Sorry, typing error. Sorry, I'm a bit confused what exactly you are asking. Acha, got your point. So you are asking then why not the PP thing is covered in the scope exclusions, right? That is what your question is, right? See, why that is not covered? Because PP&E, property, plant and equipment, is a standard which talks about the depreciation on the useful life for all the components within the larger plant and machinery, right? So that is the accounting very clear there. Now, Ind AS 16 never says that this is a provision for the future expenditure which is being depreciated, right? So under Ind AS 16, capitalization takes place only after the cost is incurred. So once the cost is incurred, that is capitalized and depreciated. So Ind AS 16 never talks about capitalizing any provisions, right? So it is not talking about any provisions, right? Hence, under Ind AS 16, there is no clash between the concept discussed over under Ind AS 16 and Ind AS 37. The only thing why I am just taking the reference of Ind AS 16 here for making you understand that this is the accounting prescribed by Ind AS 16. Hence, this is not the case under Ind AS 37 even in first place. So once we, read the question, because today we are studying Ind AS 37, right? So that's why we know that we are studying Ind AS 37. So we need to apply Ind AS 37. What if this question comes into the exam and you do not know which standard will be applicable? So now from the zero or fresh mind, you need to think through first present facts of the question demands applicability of which Ind AS. So from that perspective, if you are super clear on the concepts of Ind AS 16, on the concept of Ind AS 37, on the concept of Ind AS 2, on the concept of Ind AS 40, all the assets and liabilities standards, you are super clear. Then you will be able to quickly judge it that this is the case of Ind AS 16. So there will not be any doubt in first place. Why not Ind AS 37? Getting my point, Shruti? Because we are studying Ind AS 37 today, right? So we have a perspective that we need to think through from the eyes of Ind AS 37. But if this is the examination question, then there wouldn't be any, information available that this is India's 37 question or this is a India's 16 question. That you need to decide basis on your understanding. So, basis on the facts of this case, if this is an exam question, then basis on the facts of this case, you simply write an answer that under India 16, this overall cost will be capitalized and depreciated over the useful life. That's it. Simple. But I am just taking it here for the discussion to make it more clear to everyone. Okay. Rakesh is asking, provision is for revenue, not capital. Sorry. I could not understand your question, Rakesh. Maybe you clarify what exactly you are trying to ask. Okay. Meantime, let's do this question. I will definitely give you a break after completing the examples and questions for this concept. X Shipping Limited is required by law to overhaul its shipping fleet once in every 3 years. The company's finance team was of the view that recognizing the costs only when paid would prevent matching of revenue earned all the time with certain cost of large amounts which are incurred occasionally. Thereby, it has formulated an accounting policy of providing in its books of account for the future cost of the maintenance, that is, for example, overhauls, annual inspection charges, etc., by calculating a rate per hours sailed on sea and accumulating a provision over the time. The provision is adjusted when the expenditure is actually incurred. Is the accounting policy of X Shipping Limited is correct? Now again, go by that this is an examination question, and question in exam will never tell you which index you need to apply, right? That you need to come up with basis on the facts given in the question. Now, in this case, you let me know whether there is an obligating past event, if yes, whether there is a probable outflow, if yes, whether the reliable estimate can be made, if yes, then whether the provision is required or not. Or you might think from the perspective of other Indians too. So we need to do this brainstorming on each and every facts and circumstances, and we should be clear that this fact or circumstances is leading us to which Indians, right? Okay, I got your question, Rajesh. Now I'll discuss it after getting the responses of this question. Please type me provision required, provision not required, or say accounting policy of company is correct or accounting policy of company is not correct. So Kushma is saying no provision is required. Yedu Kondalu is saying no present obligation, so no provision is required. Okay. What about others? Okay. Let's see. A provision is made for a present obligation arising out of the past event. ये तो लाइन अब हमें रट चुकी है, राइट? हम इसको कभी नहीं भूलेंगे. Even a legal requirement to overhaul does not make the cost of overall a liability, because no obligation exists to overhaul the ships independently of the company's future actions. The company could avoid the future expenditure uh, by its future actions, for example, by selling the ship before the obligation arises, right? So there is no present obligation. As per the standard, financial statements deal with the financial position of an entity at the end of its reporting period and not its possible obligations in the future, right? Therefore, no provision is required to be recognized for the costs that need to be incurred to operate in the future years. The only liabilities recognized in entities' balance sheet are those that exist at the end of the reporting period, right? Therefore, the accounting policy of X Shipping Limited is not correct. The company should adopt the componentization approach under Ind AS 16 property, plant and equipment for accounting of for the refurbishment cost. So this is the answer given by your study material. So this is how, if suppose this question comes in the examination, right? Now in examination, we do not know which standard question, is this, right? So we need to assess first, then we need to explain that provision is not required. Why? Because there is no present obligation. Then what needs to be done? It has to be accounted for under Ind AS 16, right? So cost is capitalized and depreciated over the useful life, right? So this is how the complete answer will be given. Even if you skip on, certain additional statements made by the institute in the answer, but key points is provision is made of present obligation arising of past event. There is no present obligation. There is no past event, right? Furthermore, the cost deals for the future cost. These are the future cost, and which is dependent on the future actions. So we are not going to record anything which will be incurred in future, right? And that is not yet certain, because if I sell the ship today, I will not be liable to, incur these overall costs in the future. So my future actions may decide whether I will be incurring these liabilities or not. Since those, future actions are not yet concluded. So these are the future costs, not the past cost, right? So that's how we need to draft our response in the examination. And finally, we should give what is the correct accounting policy, and hence the accounting policy adopted by the company is not in line with what it should be, right? Okay. So Rajesh has asked one question, that provision for the revenue cost and not for the costs which are capital in nature or capitalized, right? So if there are any costs which are meeting the recognition criteria under Ind AS 16 property, plant and equipment, or under Ind AS 38 intangible assets, or under Ind AS 40 investment property, right? Then only those costs will be recognized under those respective standards. But if they are not meeting the recognition criteria of Ind AS 16, Ind AS 38 or 40, then those costs will not be recognized over there. Then we need to see whether those are the costs for which provision is required or not, right? Now, what is the recognition criteria under Ind AS 16? Future economic benefits are met and costs can be measured reliably. These are the two conditions laid down by Ind AS 16. Yes or no? Yes. Future economic benefits, that is, whatever the cost is being incurred will give a future economic benefits for more than one period. Then only it will meet the recognition criteria of Ind AS 16 to be capitalized as property, plant and equipment, right? If future economic benefits are not there, then Ind AS 16 will not take care of these costs. Then certainly, because Ind AS 37 is the only standard which talks about all, costs or other liabilities which the company is incurring because of some past events needs to be recorded. So that I cannot say that this provision is for revenue expenditure or the capital expenditure. I can say whatever expenditure is not meeting the recognition criteria under Ind AS 16 needs to be assessed under Ind AS 37. Clear, Rajesh? So let's forget about revenue expenditure and capital expenditure terminologies, right? We need to stick to the recognition criteria of the respective standards. So India 16 has its recognition criteria. India's 38 has its recognition criteria. If any of the expenditures or costs are not meeting the recognition criteria under those standards, then these costs needs to be judged under other standards, right? I hope I am able to answer your question, Rajesh. Let me see how many more examples I have. One, two. Okay, two more examples, then we will have a break. Example है contaminated land legislation virtually certain to be implemented or enacted. An entity in the oil industry having 31st March as the year end causes contamination but cleans up only when required to do so under the laws of the particular country in which it operates. So entry is a oil marketing or oil extraction company, right? And it causes contamination to the land whenever they extract the oil, but it cleans up only if it is required by the law in that particular area, state, or the country, right? Otherwise, they do not do the cleanup, right? One country in which it operates has had no legislation requiring cleaning up, and the entity has been contaminating the land in that country for several years because there was no law. So company was not incurring any expenditure for any of the cleanup activities, and it is leaving the land contaminated only, right? At 31st March 2001, it is virtually certain that a draft law requiring the cleanup of the land already contaminated will be enacted shortly after the year end. So law is at the draft stage by the government of that country, and it will be enacted or notified after the year end. So after 31st March, it will be enacted. It is assumed that a reliable estimate can be made of any outflows expected. Now, do we need to record any provision in this case? Yes or no? Present obligation as a so our rule book is same. So whatever would be the circumstances or facts of the question, we will stick to our logic tree. So logic tree says, is there a present obligation arising out of past obligating event? So the obligating event is the contamination, right, of the land because of a virtual certainty of the legislation requiring cleanup, right? Now, land has already been contaminated. Yes or no? Yes. Land has already been contaminated. And law not yet enacted, but will be enacted. This is a virtual certainty as per the facts. So after the year end, law will be there, right? As an outflow of resources embodying economic benefits. So will there be any outflow of resources? Yes. Because on 1st of April, law is getting implemented, and law will take care of all the cleanup, penalties on the entities who have already contaminated the land in the past. So company has already contaminated the land in the past several years. On 31st March, there is no law, but on 1st of April, there is a law. So law will come up with the penalties, yes or no? So outflow of resources is probable. Yes or no? Yes. Conclusion, a provision is recognized for the best estimate of the cleanup cost or the penalties. Yes or no? Clear? So we have to just check all the four conditions. And if all the four conditions get satisfied, provision will be recorded without any exception. Now, in the previous case, it was a legislation requirement. In the current case, it is a constructive obligation, right? Constructive obligation means when there is no contractual obligation or legal obligation, but company has done this in the past, or made a policy to do this, which is available on their website. So that is casting a constructive obligation on the part of the company. So in that case, what would be the case? Last example before the break. Have 2 minutes patience, please. An entity in the oil industry having 31st March year end causes contamination and operates in the country where there is no environmental legislation. However, the entity has a widely published environmental policy in which it undertakes to clean up all the contamination it has caused. The entity has a record of honoring this published policy. It is assumed that a reliable estimate can be made for any of the outflows expected. Now, do we have a present obligation in this case resulting from past event? Yes, past event is the contamination of the land, right? Present obligation is arising because past event has already incurred. The obligating event in this case is the contamination of the land, which has already been done by the company, which gives rise to a constructive obligation because the conduct of the entity in the past has created a valid expectation on the part of those affected by it that it will be taking the cleanup exercise for the contamination. An outflow of resources will be there. That is the probable. So probability is met, and estimate we need to make basis on whatever would be the cost the company will be incurring for the cleanup. And once the estimate is made, provision will be recognized. Please let me know if constructive obligation and legal obligation concept is clear, and all the four conditions basis on which we will decide whether the provision needs to be recognized or not are clear. And if there are any questions, let me know. This is 9:08 by my watch, and I can give you a 10 minutes break. Let's get back at 9:20, effectively 12 minutes break. Okay. 9:20. We will resume. In the meantime,
Sure.
Okay. So we have understood some key terms, provision, obligating event, present obligation, right? Now the next term is contingent liability. As we discussed at the start of the session, that this standard revolves around three items. Number one is provision, number two is contingent liability, and number three is contingent asset, right? So now the second item we are going to discuss. What is contingent liability? Contingent liability is a possible obligation. So here the word is possible. Okay. So please pay attention to the words. Possible obligations arising from past event. So there is certainly a past event to be confirmed by future event, not wholly within the control of the entity. So there could be a obligation, there could not be a obligation. That decision is not yet arrived because it is dependent on some future event, and that future event is not wholly within the control of the entity. So entity cannot control the event in its favor, right? So future event basis on which it will be decided whether there is a outflow of there is a obligation or not is not within the control of the entity. Or present obligation arising from a past event of which outflow of economic benefit is not probable. So in the provisions definition we saw that this has to be probable, right? And if it is not probable, then no provision, right? No provision. But there would certainly be a contingent liability because it is not probable now, but it may become probable at a later date. So hence, this will be termed as contingent liability. And or that cannot be measured reliably. So four conditions we have discussed for the provision. Number one, present obligation arising out of past event, right? Past event. Number three, probable outflow, right? Probable outflow. Number fourth, reliable measurement, right? Reliable measurement. These are the four conditions which we have been discussing till now in order to recognize a provision. If all the four conditions are met, then only provision will be recognized. Now, in the definition of contingent liability is the liability which either is a possible obligation arising from the past event to be confirmed by some future event not within the control of the entity, or is a present obligation for which outflow is not probable. So not probable, hence no provision. So there will be a contingent liability, right? Or it cannot be measured reliably now. So at the year end, it cannot be measured, but at later date, it can be measured reliably. So measurement may come in on some future date. So either it is a possible present obligation, either it is a possible obligation to be confirmed with future event, or it is a present obligation arising from past event where probability is not yet met or the estimate cannot be measured reliably, right? This is called the contingent liability. So contingent liability is a possible obligation from past event and or outflow is not probable and or unable to measure, right? Let's do the example. A tax case pending before the court, the liability for payment arising or not in respect of which depends on the outcome of the court decision. Now, outcome of the court decision is not in the hands of the company, right? correct, is a possible obligation, because if the court gives the order against the company, there will be a obligation. So at this stage, because order is not yet come, so we do not know what is the outcome, so obligation may or may not be there, right? So this is a possible obligation that arises from past event. Past event has already occurred, because this past event only led this court case, right? So past event is already happened, but obligation will be there or not, to be confirmed from future event. What is the future event? The decision of the court. So that is called the future event, right? So future event not within the hands of the company, so this is a possible obligation whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events. So occurrence or non-occurrence means occurrence of the decision in favor or against, right? And which is not within the control of the entity. So this is the best fit of a contingent liability example. So whenever there are any pending court cases, you must have been, seeing the contingent liability disclosure for the various listed companies, right? And in those disclosure, you must have observed that they have presented lot of cases over there, right? Because in the court case, company says that there is a either or outcome. Either it will be in favor of the company or it may not be in favor of the company. So that is yet to be decided, right? So basis on that, obligation becomes a possible obligation, right? Event has already occurred, which led to this, a case in the court, right? And decision is the future event, which is not wholly within the control of the entity. So this is a example of contingent liability. Let's do this question. After a wedding in 2001 and 2, 10 people died, possibly as a result of food poisoning from the products sold by the entity, right? So this entity might be a, say, hotel chain or a banquet, right? Legal proceedings are started seeking damages from the entity, but entity has disputed it, right? Up to the date of the approval of the financial statements for the year end 31st March 2002 for issue, the entity's lawyers advise that it is probable that the entity will not be found liable. So lawyers are saying, boss, don't worry, there will be no liability on you. This is probable. However, when the entity prepares the financial statements for the year end 31st March 2003, its lawyers advise that owing to the developments in the case in last 1 year, now it has become probable that the entity will be found liable. It is assumed that a reliable estimate can be made of any outflows expected. What would be the treatment in the financial statements for the year end 2002 and for the year end 2003? Would you like to tell me in the chat box? In 2002, provision or contingent liability. In 2003, provision or contingent liability. So simply punch the financial year and your answer. Waiting for your responses in the chat box. Mohammed Abdul has come up with FY2 contingent liability, FY3 provision. Okay. Others? Rajesh has said 2-0, 3 years. What nil? Nil means no provision, or nil means neither provision nor contingent liability. What should I assume, Rajesh? Shruti is saying 2002 no provision, 2003 provision recognized. Okay. And 2002 only no provision, or will there be anything else in the absence of no provision? Will there be any contingent liability, Shruti? So we need to judge from both the aspects. We are not discussing provisioning now. We are discussing requirement in the financial statements from uh, the Ind AS 37 perspective. So Ind AS 37 is dealing with both the items, provision as well as contingent liability. Manoj Kumar is saying 2002, no, 2003. Yes. Sorry, Manoj. Your answer is too limited. So I am not understanding which item you are saying no and which item you are saying yes. But I can try that no for provision, yes for provision. But you are not mentioning anything about contingent liability in both the years, right? So Shruti has come up contingent liability in 2002. Yes. Okay. Let's see what would be the answer. At 31st March 2002, present obligation as a result of past obligating event. This is the condition we need to check every time, right? On the basis of the evidence available, when the financial statements were prepared, there is no obligation as a result of the past events. Hence, conclusion is no provision needs to be recognized. The matter is disclosed as a contingent liability unless the probability of outflow is regarded as remote. So if, although obligation is not there, lawyers are saying that there wouldn't be any outflow expected on the part of the company under this case whenever the decision arrives, right? As of 31st March 2002, since there is no expected outflow, so no provision, but there might be contingent liability needs to be disclosed if outflow is not remote. So remote means, okay, probable means greater than 50%, right? Remote means less than 5%. Okay. So if lawyers are 95% sure that there wouldn't be any, outflow, then contingent liability will also not be required to be disclosed. So contingent liability is disclosed only if it is not meeting the definition of provision and chances of outflow are not uh, probable, right? But if it is very remote, very rare that there will be outflow, then even CL is not required to be disclosed. As at 31st March 2003, present obligation condition we need to check on the basis of the evidence available. There is a present obligation because lawyers are saying, boss, the case will be coming, against you, and there will be expected outflow, right? An outflow of resources, embodying economic benefits in settlement is now becomes probable. Hence, provision needs to be recognized. A provision is recognized for the best estimate to the amount to settle the obligation. And what if this best estimate cannot be made? If this best estimate cannot be made, then in that case, provision will not be recognized, right? Because this is the fourth condition. So in that case, provision will not be recognized. And then CL will be disclosed. Correct? So four conditions has to be met. Clear point? Any doubts? Okay, let's do one more question. So we have to, try our hands on different circumstances and scenarios so that we are equipped enough with the concept application, so that if whatever the circumstance or facts come up in the examination, we will be able to assess and judge them correctly and, answer them correctly. X Chemical Limited is operating in the vicinity of a river since last 20 years. A community living near X Chemical Limited claims that its operations has caused contamination of drinking water. X Chemical Limited has received notice from the governmental environmental agency that officials' investigations will be made into the claims of the pollution caused by the entity. If it is found that X Chemical Limited has caused the contamination to the river, then penalties and the fines would be levied on it, right? This notice has been received. X Chemical Limited believes that it has implemented all environmental safety measures to the extent that it is unlikely to cause any pollution to the river. Management is not sure whether it has all the information about the entire 20 years. Therefore, neither the management nor the external expert are able to assess X Chemical Limited's responsibility until the investigation is completed, right? In such a situation, how should management of X Chemical Limited account for the liability, if there is any? So these are the facts given in the question, right? So first is companies polluting the rivers for last 20 years. That is the say of the local people, right? Companies of the belief that they have implemented enough, they have implemented all environmental safety measures and it is unlikely that they have caused any pollution. However, management is not sure about this information for last 20 years. Investigation agency will come to the premises of the company. That notice has already been received. Once the officials visit the company's factory and completes the investigation, then only picture will be clear. But before that, our year has ended. And for the year ended, we have to prepare our financial statements. What we need to do in the financial statements basis on these situations and facts. Let me know in the chat box your thoughts around it. As an expert chartered accountant, company has reached out to you for a professional advice. What professional advice you would likely to give them? Muhammad Abdul is saying contingent liability as a disclosure we need to make. Okay. Others? As per the standard, in the present case, the available information and evidence does not support a conclusion that a present obligation exists. However, there is a possible obligation which exists and will be confirmed upon the completion of the investigations, because until the investigations are completed, it cannot be said that there is a present obligation. Past event is there, right? But present obligation arising out of past event is there or not, that will be confirmed only after the investigation is completed. Hence, there is a possible obligation. Therefore, management should disclose the contingent liability for the potential penalties and fines that may be imposed if contamination is proved. Right? Clear concept? Any doubts? Right, Shruti. Your answer is correct. Principles describing provisions and contingent liability. So this is the summary slide. Whatever we have discussed so far in last 10 to 15 slides is a summary here, where as a result of past event, there may be an outflow of resources embodying future economic benefits in the settlement of a present obligation or a possible obligation whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. So this is the main statement. Now, there is a present obligation that probably requires a outflow of resources. In this case, provision is required and disclosure of provision is also required. So provision needs to be accounted for as well as disclosure of the provision, right? Both the items will be required in this case because there is a present obligation, right? Requiring outflow of resources, which are probable, right? There is a possible obligation or a present obligation that may, but probably will not require an outflow of resources. In this case, provision is not required, but disclosure of contingent liability will be required because this is a possible obligation, not a present obligation, right? And if it is a present obligation, outflow is not probable. So not probable. So hence condition is not met for provision recording, right? Third case, there is a possible obligation or a present obligation where the likelihood of the outflow of the resources is remote, that is less than 5%. In this case, neither provision is required nor disclosure of contingent liability is required, right? Because chances are remote for any outflow, right? Clear? So this is the summary, whatever we have discussed in last 1.5 hours. Okay. Third key concept. So as I said, 3 items we are going to discuss. First is the provision, second is the contingent liability, and the last is contingent asset. So now we have reached to the third item, contingent asset. Contingent assets are possible assets. Contingent kaho, possible kaho, baat to ek hi hai, right? Arising from past event to be confirmed by the future events not wholly within the control of the entity, right? So there are certain assets which will be received or entity will, establish the right to receive to them, which is dependent on certain future event. So if the future event occurs in the favor of the company, then entity will be entitled to receive these possible assets, and at that date it will be regarded as assets rather than contingent assets, right? Contingent assets usually arise from unplanned or other unexpected events that give rise to the possibility of an inflow. Now, till now we are all talking about outflow, right? Now we will be talking about inflow because we will be receiving something, right? There will be some inflow to the entity, and that is a possible, not confirmed. So that's why this is not the asset as on date. this is a contingent asset as on date because entity has not yet established the right to receive them, right? The standard states that contingent assets should not be recognized. So contingent assets, no recognition. Okay. Only disclosure. Okay. So standard states that contingent assets should not be recognized as this could give rise to the recognition of income that may never be realized. However, when the realization of the income is virtually certain, then the related asset is no longer regarded as a contingent and the recognition is appropriate. So when the future event, happens and it happens in the favor of the entity, that is entity has established the right to receive that contingent asset and this is virtually certain the entity will receive that, then it means this is not a contingent asset anymore. This becomes an asset for the entity now. Hence, asset needs to be recognized. So what would be the entry? Asset account debit to P&L account. So in the P&L account, it will be treated as income, right? Because company has received something. So that will be realized as income in the P&L and debit will be asset. Correct? But do we need to record any contingent assets till the time they become assets? No. Contingent assets, no recognition. Only when contingent assets becomes assets, okay, then only we will record asset. Getting my point? Is that clear? We are not going to account for contingent asset. We will account for only when the contingent asset becomes asset, right? So asset needs to be recognized. Contingent asset is not to be recognized in the books. Is this definition clear of the contingent asset? Contingent asset, no recognition, only disclosure. When contingent asset becomes asset, we will record the asset and we will credit income statement. Mohammed is asking for sir, but for better presentation of the FS, whether we should record or disclose remote contingent liability as well. No, standard is prohibiting that. What better presentation? Standard is saying we don't need to disclose those, contingent liabilities which have remote probability of outflow. So less than 5% chances are there that there will be any outflow. Hence, those are not contingent liabilities even. So those not required to be disclosed, that is prohibited by the standard. Okay, Mohammed. Let's do an example. X Limited filed a legal suit against a supplier of goods for compensation against the damages on non-supply of contracted goods. This meets the definition of a contingent asset. Yes or no? X Limited is the buyer and Y Limited is the seller or raw material supplier. Okay. Now, as per the contract, Y Limited was supposed to supply raw material to X Limited on a due date, which Y Limited has failed. It did not supply. Now, X Limited, the buyer, is claiming a compensation for that. Now, if that compensation becomes payable to X by Y, then it will be becoming a receivable. That is, receivable is an asset. Right? But until this right to receive is established, this is a contingent asset. Because this is not yet established that Y Limited will make the payment of the damages, right? So when X Limited gets that right, then only it will record the asset. Till then, it will continue to disclose this as a contingent asset in its balance sheet, right? Since there is a possible asset compensation against damages that arose from the past event, that contract with the supplier and supplier failed to deliver the raw material on the due date, whose existence will be confirmed by the occurrence or non-occurrence of a future uncertain future event, not wholly within the control of the entity, may be the legal case which X Limited might have filed in the court of law against Y Limited. So as soon as the decision comes in, the contingent liability will become the contingent asset will become the asset for X Limited, right? So X Limited will disclose this as of now as a contingent asset only in the financial statements. Clear point? I will appreciate in case if you respond in the chat box if clear, or you want me to repeat anything so that I get to know. I know all of you are patient listeners, but still you can confirm in the chat box. Okay, let's quickly do this question. X Sugars Limited has entered into a sale contract of how much? 3 crore with Y Chocolates Limited for supply of sugar during the year 2001 and 2002, right? So X Limited is a raw material supplier which is entered into a contract of supplying sugars to the chocolate company, right? As per the contract, the delivery is to be made within 2 months from the date of the contract. So within 2 months, this contract has to be fulfilled. In case the failure to deliver within the schedule, X Sugars Limited has to pay a compensation of how much? 30 lakhs, right? Okay. To chocolate company, Y Chocolate Limited. During the transit, the vehicle carrying the sugar met an accident and X Sugar Limited lost the entire consignment. It is, however, covered by an insurance policy. According to the report of the surveyor, the amount is collectible, subject to the deductible clause that is 15% of the claim in the insurance policy. The goods cost of goods lost was rupees how much? 2.5 crore. Okay. So 2.5 crore was the cost of the goods which was lost in the accident. Before the financial year end, X Sugars Limited received informal information from the insurance company that their claim has been processed and the payment had been dispatched for 85% of the claim amount. Meanwhile, Y Chocolates Limited has made demand of 30 lakhs since the goods were not delivered on time. What provision or disclosures would X Limited need to take in its year-end financial statements? Facts are clear, circumstances are easy. Please let me know what all needs to be done in the financial statements of the raw material supplier, that is X Sugars. So 30 lakh is the penalty demanded by the chocolate company, and insurance company informally informed the company that their claim is admitted and will be discharged for 85% of the claim amount, right, as per the insurance policy clause. Now you tell me what all accounting treatments disclosures you will do in the financial statements of the X Sugars Limited. Practice as much as possible. I'm waiting for your responses in the chat box. Mohammed is saying asset recognized for 85% payment and 30 lakh as a contingent liability if disputed or else actual liability. Okay. Let's see. As per the standard, where an inflow of economic benefits is probable, an entity should disclose a brief description and the nature of the contingent assets at the end of the reporting period, and where practicable, an estimate of their financial effect measured using the principle set out in India's 37. Okay. X Sugars Limited would need to disclose a contingent asset. So this is not an asset yet. This is a contingent asset of how much? 85% of the cost of the consignment lost, right? So this is how much? 2 crore 12 lakh and 50,000 is the amount that they will be disclosing as a contingent asset at the end of the financial year 2001 and 2, because this is not yet officially confirmed by the insurance company. It's just a matter of fact that somebody at the company, X Sugars, might have spoken over the phone to the surveyor or customer care, and they simply said, yes, as on this date your claim is still in process, although it is not yet approved, or even if it is approved, it will be processed. So but no formal communication yet, right? So it is an informal communication. So we cannot say that entity has established the right to receive. So no right to receive is established yet unless there is a letter received by the entity from the insurance company that your claim is processed and it will be credited in your bank statement in next 10 working days or whatever period, right? So until then, it will be a contingent asset only. So if we are preparing financial statements, we will be disclosing that as a contingent asset. However, entity will also required to be record a provision of rupees 30 lakhs towards the claim of white chocolates, because now the consignment is not delivered, so it is defaulted on the part of the company. Hence 30 lakh provision has to be recorded for. Now we can add certain twist to these facts. For example, if X contest in the court of law that this is a event occurred out of the control, I have already dispatched the consignment, it just met an accident, hence damage clause shouldn't be applicable. So that will be decided basis on the court decision. But if that is not the fact in the question, then 30 lakh is the provision needs to be made, right? I hope answer is clear and acceptable to everyone. If there is any question, query, let me know. So Praveen, you are right in your answer. Manoj, I hope after seeing the answer, you must be accepting it, that contingent asset needs to be disclosed, right? Okay. So we have covered all the three terms: provision, contingent liabilities, and contingent asset. Now we will be talking about the measurement rules given in the standard. How and when these measurements needs to be done. So are there any techniques or methodologies which we need to use while measuring the amount of provisions and amount of contingent assets or contingent liabilities? So what are the general rules or rules given by the standard? So standard talks about that there are some ways which can help us in measuring the provision amount, contingent asset amount, contingent liability amount. So one is best estimate, right? Then there are certain factors which will affect the measurement. What are the risks and uncertainties involved? Then there is a present value rule. Then there is a future value rule. And then expected disposal of assets is another concept which will impact the measurement. So we'll discuss this one by one. For today, I will be talking about first one, and remaining portion we will be covering in our next session. Measurement, best estimate rule. Best estimate, as the name suggests, whatever best estimate you can make should be the measurement amount, right? The amount provided should be the best estimate at the end of the reporting period of the expenditure required to settle the obligation, right? Ind AS 37 refers best estimate as the amount that the entity would rationally pay to settle the obligation at the end of the reporting period or to transfer it to a third party at that time. Now, under the best estimate, there are two techniques which we can use. Number one is expected value method. Number two is most likely outcome method. So most likely outcome method is like head or tail. So either the outcome will be head or it will be tail. Either the outcome is yes or it will be no. So binary outcome. Yeah, 0 or 1, right? That is called most likely. Whatever is most likely, either 0 or 1. So binary outcome, right? Expected value. Expected value means when there are outcomes, more than 2 outcomes can be possible. So if there are more than 2 outcomes possible, then we will assign weight to each outcome and then we will calculate the expected value, probability adjusted value, right? Probability adjusted value is called expected value, right? Is used to measure a provision where large population of items or outcomes are involved. The obligation is estimated by assigning weights to all the possible outcomes and basis on their associated probabilities, right? And most likely is binary output, right? So let's quickly do a question. Company A sells a product with 1 year warranty. Number of items sold are 55 lakhs. Okay. Cost to repair one item. If the defect is a minor defect, 20 rupees will be incurred by the company. If the defect is a major defect, then 60 rupees will be incurred by the company. Past historical data is analyzed and statisticians have come up with the probability matrix that 75% of the goods are found having no defects, 20% found minor defects, 5% found major defects. What would be the best estimate of the warranty cost? So here, because outcome is more than 2, so which method we will apply? Expected value method, right? So no defects, 5 lakhs into my 75% into my 0 because no cost is to be incurred because no defect. 5 lakh items into my 20% into my 20 rupees is the cost per unit to be incurred. 5 lakh is the item, 5% is the probability and 60 rupees is the cost. So 0, 20 lakh, 15 lakh. So total amount is 35 lakh. So this is the best estimate of provision for warranty, right? So this would be the amount at which provision needs to be recognized in the books. Most likely outcome, an entity faces a single claim with a 40% likelihood of success with no cost and 60% likelihood of failure with a cost of rupees 1 million. So there is a court case going on against for the company. Chances of winning are 40% and chances of losing the case are 60%. So if company wins the case, there will be certainly no cost. If company loses the case, 1 million is payable. Expected value is not the valid expectation, valid in this case because the outcome will never be a cost of rupees 6 lakhs. That is 60% of 1 million. Either 1 million pay or no pay, right? So this is a binary outcome. Hence, most likely outcome method will be applied here. Index 37 indicates that provision may be estimated at the individual most likely outcome. In this example, it is more likely than not that cost of 1 million will result, and therefore provision of rupees 1 million should be recognized in the books, right? I cannot say because chances are 60%, so I will pay you 1 million into my 60%. Chances are 60% of the payment, but if payment has to be made, it has to be made for 1 million. So provision will be for 1 million basis on the most likely outcome method. Clear? So this is a easy method which we have applied, in our IGAP scenarios as well. As such, there is no difference, right? Any doubts? Please let me know if you have any doubts you want me to repeat thing, whatever we have discussed on this. Yes, no. Okay. So I think it's time now, and we can wind up the session for today. And the remaining portion we will cover in our next session, due on Tuesday. Till then, I wish you all the very best. Enjoy the Diwali season. Have safe Diwali, prosperous Diwali for everyone. Okay. Thanks for listening me patiently. See you soon. Yes, session is over for today.